Hello guys, in this video I want to talk about the book called The Intelligent Investor and showing you a glimpse of investment strategy by Ben Graham. The Intelligent Investor book recommended by Warren Buffett and was written by his professor named Ben Graham. Ben Graham was a father of value investing. He was so genius. I read the book 3 times and I'm going to read it again for the fourth time this summer. I learned so much from this book, and I know, guys, if you go ahead and read this book, it's going to change the way you invest your money. It doesn't matter, stock market, real estate. It's going to change your mind. It's going to change your brain. It's going to change the way you think about investment. Let's go ahead and start it. This is my first video talking about these things, and I don't want to make it really long, like 30-40 minutes. I'm going to go ahead and talk about it little by little. And then in future videos, I'm going to share more about this book and many other books I read. Okay, in this book, Ben Graham talks about no speculation. Like if you speculate, basically you're gambling. It's like sitting on the blackjack table, guessing and predicting things and trying to win money. And you might win like one night, 2 night, 3 nights, but in long term, you're not gonna be a winner. You're gonna lose some money. Uh, it's like a gambling game. So in a stock market or investment, I should say, any type of investment, you don't have to speculate while you can think and find a real reason of investing and not predicting things based on uh, you know not knowing what you're doing. So no speculation. Speculation is the other term for gambling. So don't gamble with your money. Invest. Investing uses a basis of fundamental and analyzes. So make sure you use fundamentals. Well, let's say you invest in stock market, you have to know those fundamentals. You need to know a little bit of accounting in order to read financial statements, balance sheet, income statements, cash flow, 10K. So make sure you understand those. There are plenty of information online and the YouTube platform that you can learn this stuff. It's not that hard. So make sure when you're trying to buy a company in a stock market, buying a piece of business, make sure you understand the fundamentals first and then analyze the company and compare it with the other peer companies. Short term. Short term investment is always a bad habit. So make sure you're not planning to invest your money. Let's say you have $10,000. Make sure you understand that $10,000, if you're trying to put it in work and thinking that in 2 months you're going to gain like $15,000, $20,000 and you're guessing, you're basically gambling. Make sure you're not planning for that because anything can happen to the market. People who were investing in January or February didn't know in March 31st the stock will go down dramatically. And many people lost some money, and uh, after that, many people gained significant amount of money after March 31st when the market was at the bottom. So make sure you're not focusing on short term. Short term means less than a year. Don't focus in 3 months what the stock market is gonna do in 3 months, 4 months, 6 months. Or not just the stock market, in real estate, same thing. You have to plan for long term. Long term is the key factor, or we can say long term is the focus. So short term is not a good investment. Always focus on long term, more than a year. I have a stock. Maybe in future videos I will talk about it and what's the reason I think that this stock is the right stock for me. I hold this stock since 2015. Well, I should say by end of 2015, December, we can say from 2016. And I have no plan selling this is stock. If it goes down by 50, 60, 70, 80, or even 90%, which is not happening, I believe, but if it goes down by 90%, I will buy more. If it goes up, I might buy more, but no, I'm not planning to sell this stock. And you should do the same. You should focus on a company that you like and you think it makes sense based on your own research, and then keep adding to your position. So to make sure you're not buying any stocks or buying any type of real estate, residential or commercial, or any type of business based on others' opinion. So make sure you just do your own research. This is a short term. This is the chart from Dow Jones Industrial. I want to show you something right here. So in short terms, you might lose money or you might gain some money. But in long term, as you can see in this green line, in long term, the market goes up. There is no downward. It's just up, 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 up. But in short term, the stock might go down. Let's say from this point right here. Oh, let's say from this point, you invest some money in this point or this point. The market goes down and you scared a lot. So you sold your stock. You lost significant amount of money. But if you hold it and not selling it, and let's say you paid right here, you paid so much money right here, and then you hold it for, let's say 5-10 years. Although this chart, the years are so long, and let's say you hold this stock for 10-15 years, you're not going to lose money, although your profit or your gain will be less because you bought a share of a stock at the peak of the market. But you didn't lose any money. If you hold the stock for a long period of time, you're not going to lose money. And you have to make sure you understand the company when you're buying it. So if it's, see right here, this peak, if you're buying this company at the peak, like when the prices are crazy high, your return will be lower in the future. It might take many years to gain more profit out of company. So make sure you understand the price you're paying for it. Later on, we're going to talk about these things. This is S&P 500. As you can see, long term, the market is going up. This is another thing, Ben Graham. This is later. I was going to talk about something, but at the end of the video, I'm going to share something with you guys. This is another thing Ben Graham talks about, the intelligent investor, talks in the Intelligent Investor book. He says that recovering is not easy from the financial loss, and it's not easy. He gave a great example. It says if you lose 80% of your portfolio money, it takes 500% to gain the money that you lost, to bring it back where your investing value started, where your investment has started. So basically, let's say you have a portfolio of $10,000. You bought a poor company and the company goes down, keep going down, 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 down for, let's say 2, 3 years, 4 years, 5 years. And your 10,000 portfolio value is now worth only $2,000. So you lost 80% of your portfolio value. Now your worth is $2,000. So you have to find something, or the same company has to gain 500% from the point you are now in order to get back to $10,000 initial investment you had, let's say 5 years ago. And if the company is going down like that, in my opinion, 99.99999% of time the company would not go higher like that percentage. Like, it's not going to gain 500% because there is something wrong with the company if it goes down by 80%. and the chances of getting back to let's say $10,000 investment is really hard. So you have to find other investment to cover that loss, and it's not easy to find a company to gain 500%. Unless you're just speculating, like gambling. Some people are doing it on cryptocurrency, and some like crazy overvalue the stock. Sometimes you might cover or not, but it's just up to the person who's investing. If you want to invest, you have to focus on fundamentals and many other things that we will share right here in this video. Or you can gamble with your money. You might gain back that 500% easy, and sometimes you're going to lose that 20% left from your portfolio too. So recovering is not easy. Make sure you understand the company you're investing. A great example of financial market history in United States. If you had invested $1 in United States stocks in 1900 and spent all your dividends, your stock portfolio would have grown to $198 by 2000. Let's say you invest $1 in the stock market in 1900. I know many people are not living that long, like 100 years, but this is just an example. It can open your eyes in the market. And let's say you invest $1 in the market and you spend all the dividend they gave you, and you spend it on something else. Let's say you bought a hat, you bought shoes, you bought something else, you bought a car, you spend all those money, and your account balance after 100 years had the $198, which is really great. I mean, you can't start saving for your son and your future, children and grandchildren. So, but if you, this is the power of dividends. But if you had reinvested all your dividends, your stock portfolio would have been worth $16,797. Huge different. Almost, I can say that this is almost 80, 90 uh, uh, times more than what you had in your account if you reinvested that dividend. So dividends matter. The dividends is really important if you want to grow your money. And it's a dividend is an important key factor in your portfolio. So make sure when you buy a company, not all the companies pay dividend, but make sure those who pay dividends, make sure you buy a right company who pays a great dividends. Well, Ben Graham in his book he talks about the dividend of 3% to 3.5%. It depends to the company, and you should get a return between 6.5 to 8% every year. 3 to 3.5 percent from dividend, 3 to 4% appreciation from the stock, and that's a great investment. You don't want to go higher. Some stock, I know some stocks paying like 8%, 9%, 10%, even 16%. Those are risky company. And like I said, we don't want to gamble. We want to invest our money. We want to put it in this place that is uh, not 100% safe, but as safe as possible. You should invest consistently. Dollar cost averaging, where um, Ben Graham talks about it in his books. I lost some of the information. He gave us a great example about dollar cost averaging on a stock, but I found it on internet and I put it on the next slide. We're going to talk about it. So make sure you transfer some portion of your income into your brokerage account every month, every 6 months, or every year, and never time the market. Timing the market is basically gambling. So don't time the market. Just try to invest consistently every single month, and you should be in a good position. And you should, you shouldn't just um, invest your, let's say you have $10,000 in your bank account, you have to start investing it slowly. Like, let's say you invest $2,000 now, and then you wait like 2 3 months. Maybe the stock goes down, maybe go higher. If it goes down, you buy like $2,000 $3,000 more, and then you wait. If it goes down again in 2 years, 1 year, 6 months, you're gonna start adding to your position. So you're not gonna pour that $10,000 saving in one day into a stock, because you I'm not going to say you lose money, but you might lose an opportunity to buy more stock of that um, company when the company is at lower price. So never time the market. Here is the great example. Timing the market. If you time the market, let's say you have $600 in your account, ready to invest. You invest $100 in the first month when the stock is at $50. You buy two stock. That's how much you can afford to buy with $100. And then in February, you decide to wait because the stock went down 50% by 50%, and the stock of the company you bought last month at $50 is now trading at $25. And you say, hey, this company, maybe it's not a good company. I shouldn't invest any money in it. And you don't buy any share. You could buy, if you put another $100, you could buy four instead of two, but you didn't buy any, and then the stock goes down $20. You don't buy any either. You could buy five. You don't buy any. And then April goes down. Some people are just scaring, and some people are emotional. They might sell a stock at the loss, but that's crazy. Never do that. And in May, the stock goes down to $10. You don't buy any, and then you wait. In June, you see that the stock is going up. It goes to $20, and then you spend $500 to buy 25 shares. You did a great job buying 25 shares at $20, but you lost an opportunity right here. You invested $600, and you have 27 share of X companies, and total value of your investment is $540 now. And you invested $600, so you basically lost. I don't want to say lost money, but lost so much opportunity to gain more money when the market was down at $10 and $20. So at this dollar cost averaging, this guy, let's say a smart guy, invest $100. He invested the same amount as you invested, or me. I'm not gonna say you, like anybody invested. But this guy was really smart. He invested $100 every single month, not getting emotional to pour all in when the price was at $500. I mean $50, and not getting excited, not investing in these months when the stock was low, and when it start going up, investing like $500 like this guy. This guy is really smart. He invested $100 every single month. So he saw when he started like this guy. He bought two share, and in February he bought four share because the stock was down, and he started investing more, more, more. He ending up having 36 shares instead of 20 shares, 27 shares, and his portfolio value on that stock is $720. Compared with this guy, $540. There, there is a big difference between these two portfolios. So if you do dollar cost averaging, you're basically taking advantage of the price, market price, and it will be beneficial in the future, future of your cost. So always make sure you do dollar cost averaging by investing consistently every single month, or every 2 months, or every 3 months. Make sure you do that. Do your own research. You have to understand accounting. You have to understand accounting because some of these fundamentals are financial reports like income statement, balance sheet, cash flow, 10K, all these require understanding of accounting to read these financial reports. And there are plenty of channels like YouTube channels that talk about these things, and it's absolutely free, easy to learn. Just do your things and do your homework and stay in these uh, channels and learn things from these people. I don't have any specific names, but if you just search it on YouTube website, it will bring so many people that are teaching like how to read financial statements, and it's great. And it doesn't cost anything, and you will learn something from it. And analyze the fundamentals. You have to analyze fundamentals, like you, let's say, comparing. Okay, in these two sections I'm going to tell you something. Let's say you want to buy a share of a Verizon. All you have to do, just open up the fundamentals, financial statements, um, and start comparing it with, let's say, T-Mobile, AT&T, and uh, uh, other peer company that is doing the same thing. So compare this company with each other. Compare the balance sheet. Compare the balance sheet of Verizon with T-Mobile and AT&T. See what are the differences, and then try to predict that. Let's say Verizon, what they're gonna do when the 5G comes compared to AT&T. Who's gonna be a leader, and who's gonna have a better service and system. Try to just analyze things, and after you're doing all these things, try to analyze your risk, and then just try to see the negative side of the company and positive side, and decide if the company is worth of investing or not. And do more research. Try to research online. I don't know. I'm not a fan of listening to people about the company, and not listening. This is not a right way to say. I'm in a fan of taking information, like collecting information. So I will do more research. And if you're trying to buy a company, try to Google it. Try to search it on YouTube platform and see what other people are saying about things. What people are saying about that company, and um, just collect your information, and then analyze those information, see if the company is the right company to invest or not, and then goes uh you know after you finish collecting all those information, go to valuation and value that company based on the information you have. Never buy a stock or never invest in any residential, commercial, uh, real estate, or never buy a stock of a company based on others' opinion. So if someone says this company is gonna go up because I tried their food and the food is amazing. My father liked it, my mom liked it, and I like the taste of the chicken breast they have, and because of the chicken breast taste really good, the stock might go up 15% because the chicken sales are 15% of their income. Never buy a stock based on other people's opinions. So make sure you do your own research, and uh, based on your research and your information, try to value a company and then start investing in those companies. And one more thing I want to talk about is that Ben Graham talks about um, um, people investing in stocks and bonds. He says if you see people are screaming like buy this stock because the stock is going up, and people are just going crazy sometimes on some type of stocks. I'm not going to name any stocks, and the stock goes up like 20, 50, 60% in like 2 days, 3 days, 1 month, or goes up 200% in like less than a year. Ben Graham says that do not go to these company, even if it's a great company, because um, it's a high risky company and it might go down. You might lose some money, and volume or volatility in those stocks are really dangerous. So do your own research. I wish, I always wish like Ben Graham was alive at this time and I could take his course in person and talk to him a little bit. Uh, I don't know if if I could go back. I'm not that old, but like if I could go back and learn something from him in person was something that I would love to do, but it's not possible. Okay, thank you guys for watching my video. In future videos, I'm going to talk about Ben Graham and other books that I read from different people and share some of the information I learned. Thank you so much for watching this video.